In this video, I'm going to review part 2 of the notes, Financial Markets and Interest Rates. After listening to this video, you should read the notes on your own. This part really just provides a review of some terms and ideas that will show up again and again in the class, so it's worthwhile that we spend a little time reviewing. The first thing we want to talk about is stocks and bonds. We'll look at stocks and bonds in a lot of detail in a later section on valuation, when we determine how much are stocks and bonds, how much should they be worth. Here we want to talk a little bit about the terminology. So bonds are an example of a debt contract, which is simply a promise to repay a specific amount in exchange for funds now. Sometimes people talk about an IOU, like I owe you this amount of money. Bonds are tradable. That is, if I buy a bond from a company, I can sell it to someone else. And so a bond is an example of what is called negotiable debt. It can be bought and sold. Bonds offer two kinds of payments: a regular payment, generally made every 6 months, called a coupon payment, and then a payment made at the end, which is called the par value or the face value. When that bond makes its final payment is called the maturity date. So here we have an example. To raise money to build a plant, General Motors issues a bond that has a coupon yield of 5% paid semi-annually and a face value of $1,000 with a maturity of 10 years. So let's see what payments will be made on this bond. It will pay a coupon of $25 twice a year for the next 10 years. Okay? And we find that coupon payment by saying it has a coupon yield of 5%. So we take 5% of the face value of $1,000, and that's $50. And we split it into two parts since it's paid semi-annually, twice a year. So it has two payments every year of $25. And then it has one payment after 10 years, the maturity date, of $1,000, the face value. So you'll see a description of a bond, okay? And then you have to figure out what the payments are. An important idea with bonds is that the price of the bond is determined in the market. So let's say I buy a bond from General Motors. I give them $1,000. They give me this bond. I could sell this bond to someone else. Now the coupon payment and the face value of the bond generally remains the same, no matter who owns it. But if I sell it to my friend next door, okay, I can get whatever price I can get. Maybe I can get a higher price. Maybe I can get a lower price. So that market price of the bond goes up and down over time. Since the price is changing, the return you would get investing in the bond will change too. And we'll see how that works in a later lecture. One way of organizing bonds is by who issued the bonds. And so we have some terminology. If a bond is issued by a business, it's called a corporate bond. When the U.S. government issues a bond, it's called a government bond or a treasury security. And they can come in different types: treasury bonds, treasury notes, or treasury bills. And if a local government, such as a city or a state, issues a bond, we call it a municipal bond. Stock and equity, right, is the other way we know for companies to raise money. Again, in a later lecture, we will look at how to price stock, at least some very simple ways. Stock is like bonds in that they're both ways for a company to raise money, but stock differs in a couple of ways too. Stock represents ownership in the company so that the person who owns the stock can vote on who manages the company. And while stock offers payments such as dividends, they're not guaranteed like the debt payments, the coupon payments. So the dividends could be paid or could not be paid depending on how the firm is doing. Also, the lifetime of stock is indefinite, unlike that fixed lifetime of bonds. We want to talk a little bit about the process of creating securities. So when a company issues stock and that raises money for it, we call that the primary market. So when I bought that bond, or if I bought some stock from General Motors, I give them money, they give me the stock or bond. That's a primary market. If I sell it to my neighbor, GM isn't involved. They don't get any money from that. That's just a transaction between two of us investors. And we call those kind of transactions secondary market transactions. The first time a stock is offered to the public is called an initial public offering. So the stock is offered to the general public, and this is the first time, the initial time. And we call that an initial public offering, or IPO. We'll talk more about that again when we talk about how companies raise money in a later lecture. The capital market is a term that we refer to the entire financial sector where the demanders and suppliers of funds, remember them from part 1 of the notes, okay, where they get together for companies and individuals looking to raise money for long-term projects. That's the capital market. This is a little bit about stock exchanges and stock quotes, and you don't need to worry about that. So we're just going to skip through there. We do want to talk a little bit about other financial markets, while we're going to spend most of our time with the capital market, because the capital market is really important for both investors and companies trying to raise money. There are other financial markets. One financial market is called the money market, and the money market deals in one particular kind of security, basically short-term, low-risk debt securities, right? So these are kinds of bonds, but they're very short-term. They have a maturity of generally a year or less, and they're very low risk, so the chance of you getting your money back is very good. And so we have different examples of securities in the money market: treasury bills, negotiable CDs. So again, treasury bills are bonds issued by the US government of maturity of 1 year or less. Negotiable CDs are certificates of deposit, like you might see if you went to a bank, but these can be bought and sold by investors. Commercial paper is just a funny name for a kind of corporate bond. So we'll look a lot at corporate bonds and when we do bond pricing, but some kind of bonds are very short term. The company intends to repay them in a year or less, and we call those kind of bonds commercial paper. The money market plays a particular role in the economy. Since the securities are low risk and short term, they generally don't pay very good interest. So this is, if you're investing for the long run, you really wouldn't put your money in the money market. But from the investor side, it can be a short term place to park money if you kind of want someplace just safe to keep money for a little while. When we look at investing strategies way at the end of the course, we'll come back and talk about the money market in more detail. Derivatives markets are for things like options and futures. It's a very important market, but we're really not going to talk about it much in this class. We have an entire class in options and futures, and if you're going on in finance and you're thinking about a career in investing, it's something you should take. Foreign exchange markets are where currencies are exchanged. We will talk about this. While we do have an entire course on international financial management, which is a great course, everyone should know a little bit about how currencies are exchanged. And so we will do some calculations in 2 separate videos looking at calculations with currencies. You remember supply and demand from your Introduction to Microeconomics course, and we'll use the notions of supply and demand in this class too. The difference is, instead of talking about something like the market for apples, we'll talk about financial markets. Okay? So again, some of this should be familiar. We've got demand, we've got supply, but the quantity and the price are a little bit different. The quantity is the amount of money exchanged. Again, the demanders and suppliers of funds. How much money do they exchange? What is the price of the money they exchange? Well, that's the interest rate. That's why there's an R up here instead of a P. And so we can think about doing supply and demand problems with financial markets. And if you get one of these problems, and you might on an exam, you want to be sure to take it in 3 steps. Step 1 is determine what is being changed. Step 2, determine whether the change affects supply or demand, in which way the curve will shift. And step 3 is shift the curve and see what happens to interest rates. Here's an example, although it's an out-of-date example. This was written a while ago. But there's talking about the baby boomers, which is a demographic bulge. A large part of the economy is people of this age. And when they were in their prime working years, they were saving a lot of money. And so we want to say, okay, what is the effect of them saving a lot of money on the financial markets and interest rates? So we go down here and we're going to use our supply and demand analysis. So the first part is they saved a lot of money. So that's step one. What did they do? They saved money. 2, does that affect supply or demand? Well, this is the supply of funds. They're saving more money. They're supplying more funds. So it affects supply. And which way does it shift the curve? It shifts supply to the right, right? The supply is increasing. So we see a shift from S to S prime. So our step 3 for supply and demand was then shift the curve. We do that, and we see that the interest rate should fall because of this change. Okay? And so that's how we can talk about a change in the economy and use the supply and demand diagram to think about what's going to happen to interest rates. The last thing I want to talk about is interest rate premiums for risk and other factors. And this is one of the ways we can think about interest rates, by breaking it down into the various factors that make up interest rates. So here I talk a little bit about risk. And so I said if we're going to lend a person money, if they're safe, well, we might charge a lower interest rate. If we think there's some risk of that, we need a higher interest rate to compensate for the chance that they might not pay us back at all. Right? So let's say there is a risk of someone defaulting. Well, if they do default, we lose our money, but if they don't default, we get a higher return, and that compensates us. We'll talk a lot more about this when we talk about the risk-return trade-off, because that's an important concept in finance. So here we have some different kinds of risks. The default risk, and that's the risk you're not going to get paid back. So this is maturity risk. We'll talk more about this when we talk about bonds. So you just need to have that notion of maturity, how long a bond is. And maybe if the bond has a maturity of 5 years or the maturity of 30 years, they have different amounts of risk. And here we have liquidity risk. You've probably heard the term liquidity before. Right? Liquidity is a notion of how easy it is to sell an asset. But we need to be a little bit more precise about that. So imagine you had a rare collectible car, okay, and you wanted to sell that. You could sell it tomorrow if you'd offer half price for it, but who wants to lose that much, right? So instead, to get the full price of the car, you're going to probably have to wait maybe several weeks, maybe a month to find the right person to buy the car at the full price of the car. Okay? So that's an illiquid asset because we could sell it quickly, but we could only sell it quickly if we drop the price a lot. A liquid asset is one that we can sell quickly without a reduction in price. Liquid assets are more valuable. We like liquid assets. So things that are illiquid, that is not liquid, we need to be compensated for holding those kinds of assets.